Wall Street treated the bond market like the boogeyman yesterday, but today, the fixed income world doesn't look nearly as terrifying. Hi, I'm Adam Schell, and this is America's Markets. For the past few weeks, a big sell-off in government bonds that started in Germany and spread to the US has raised alarm bells. And that's why yesterday's early selling pressure, which pushed the yield on the 10-year US government bond up to 6-month highs, put a scare into investors. Higher interest rates mean higher borrowing costs for things like mortgages, student loans, as well as businesses. They also could cool economic growth, slow the housing recovery, and hurt corporate profits, thus all the angst. A lot of the selling came from investors that have been buying bonds like crazy with the thinking that prices would stay up and yields would stay low. But better economic data in Europe and signs that deflation is less of a threat has made the bond bulls a tad nervous. But in early trading today, investors are back to buying bonds, not selling them. That has pushed the yield on the 10-year Treasury note back to 2.21%, well below yesterday's brief spike to 2.35%, its highest level since late November. Similarly, long-term government bonds in Europe are also finding buyers today, pushing yields down there too. The stabilization of bond yields is good news for investors, as panic selling could lead to sharply higher borrowing costs and cause market havoc for investors, especially those that own a boatload of bonds.